The media wants you to believe that the most dangerous event of 2026 happened in Venezuela. They want you to focus on the oil fields. They want you to focus on the military operations. They want you to focus on the geopolitical noise that fills your screen every single night. This is a distraction. It is a sleight of hand so massive that it borders on financial malpractice. While you were glued to the headlines about South America, something far more terrifying happened in Mumbai. Something happened that changes the fundamental safety of your retirement account. The Reserve Bank of India quietly confirmed a massive liquidation of United States assets. We are talking about a sell-off that the mainstream financial press is deliberately ignoring. They are ignoring it because it breaks their narrative that everything is fine. They are ignoring it because if they told you the truth, you would panic. But I am going to tell you the truth. The truth is that the foreign creditors who have funded the American debt lifestyle for 40 years are leaving the building. They are selling. They are getting out. And this creates a terrifying question that no one on television is asking. If India is selling billions of dollars in US debt, and if China is refusing to buy new debt, and if Russia is completely out of the system, who is going to buy the trillions of dollars in new debt that the United States government issues this year? Who is the buyer of last resort? The answer is not the Federal Reserve. The answer is not a foreign ally. The answer is you. The answer is your 401k. The answer is your IRA. The answer is the pension fund that you are counting on to pay your bills when you stop working. In this deep dive, I am going to expose the mechanism that is being built right now to trap your money in a system that is burning down. They call it prudential regulation. I call it the silent confiscation. This is not a conspiracy theory. This is a mathematical necessity for a bankrupt government. And if you do not understand how this trap works, you will be the one paying the bill for the greatest debt bubble in human history. The Exodus. To understand the trap that is being set for you, you first have to understand why the trap is necessary. It starts with the data that came out of the Reserve Bank of India. From October 2024 to October 2025, the yield on the 10-year US Treasury bond was trading in a range that looked attractive on paper. It was offering a return of 4 to nearly 5%. Historically speaking, that is a decent number. In a normal world, foreign central banks would be lining up to buy that debt to earn that interest. But India did the exact opposite. They did not buy. They sold. They cut their holdings of US Treasury securities by approximately 21% in a single year. They reduced their exposure from roughly $241 billion down to about $190 billion. That is a liquidation of over $50 billion. This is a massive amount of capital to move in such a short window. But the number itself is less important than the signal it sends. The Reserve Bank of India employs some of the smartest risk managers in the world. They have access to data that you do not have. They have private lines of communication with the IMF and the Federal Reserve. And after analyzing all of that data, they came to a cold conclusion. They concluded that the United States Treasury bond is no longer a safe asset. They decided that the return of their capital was more important than the return on their capital. And they are not alone. Look at China. The media tells you the Chinese economy is collapsing because their real estate market is down. But look at their money supply. China has expanded its M2 money supply to nearly $48 trillion. That is more than double the money supply of the United States, which sits at around $22 trillion. But here is the critical difference. When the U.S. prints money, it goes into financial assets to prop up the stock market and suppress yields. When China prints money, it goes into the real economy. It goes into infrastructure. It goes into manufacturing capacity. It goes into gold. China is using its printing press to accumulate hard assets. The United States is using its printing press to service debt. This is a divergence of historic proportions. The two biggest potential buyers of U.S. debt have left the market. China is buying gold and copper. India is selling bonds to buy gold and protect its sovereignty. This creates a massive liquidity void. The United States government is running a deficit that requires them to sell trillions of dollars in new bonds every single year just to keep the lights on. They need a buyer. They need a sucker. And since the sophisticated sovereign wealth funds abroad are refusing to play the game, the government has to find a buyer at home. They need a buyer who cannot say no. They need a buyer who is legally required to purchase their debt regardless of how bad the investment is. That buyer is the American retirement system, the trap. This brings us to the concept of the captive audience. In the financial world, a captive audience is a group of investors who have no choice but to buy what is being sold to them. Right now, there is roughly $35 to $40 trillion sitting in U.S. retirement assets. This includes public pension funds. This includes private 401k plans. This includes IRAs. This includes the reserves of insurance companies. This is the largest pool of sticky money in the world. It is money that does not move fast. It is money that is heavily regulated. And most importantly, it is money that belongs to people who are not paying attention to the bond market. This makes it the perfect target for a government that is desperate for funding. The mechanism they use to access this money is called financial repression. It sounds technical, but the concept is very simple. Financial repression is when a government uses regulations to force private capital to fund public debt at artificially low interest rates. They do not come to your house and take your money. That would cause a revolution. That would cause people to march in the streets. Instead, they change the rules of the game so that your money flows to them automatically. They do this under the guise of safety. They will tell you that the stock market is too volatile for retirees. They will pass new regulations called Prudential Standards. These regulations will require pension funds and 401k providers to hold a certain percentage of their assets in high-quality liquid assets. And guess what the government defines as a high-quality liquid asset? US Treasury bonds. The same bonds that India is dumping. The same bonds that China refuses to buy. The government will mandate that your retirement fund buys them. This is how they fill the hole left by the foreign exodus. They transferred the toxic debt from the balance sheet of the Reserve Bank of India to the balance sheet of your retirement fund. India gets out. You get locked in. This is already happening in the banking sector. Under the Basel III and Basel IV Accords, banks are required to hold massive amounts of government debt to meet liquidity coverage ratios. Now, policymakers are looking at the retirement sector and licking their chops. They see a mountain of cash that is unguarded. They see a population of retirees who are scared of a stock market crash, so they will pitch this as a safety measure. They will say, "We are protecting you from risk by requiring your fund to hold government bonds." But they are not protecting you from risk. They are using you as the collateral for their own bankruptcy. They are turning your nest egg into the dump site for the debt that nobody else wants. I want to pause here and ask you a question that you need to answer honestly. Do you believe the government has the moral right to force your retirement fund to buy their debt for the greater good? Do you believe they have the right to use your life savings to plug the hole in their budget? I want you to answer yes or no in the comments below. Because your answer to that question determines whether you are going to be a victim of this system or a survivor. The silent theft. Now let's talk about the math of the theft. You might be thinking, okay, so my 401k buys government bonds. Bonds pay interest. What is the big deal? At least I am not losing money like I would in a stock market crash. This is the most dangerous misconception in finance. In a period of financial repression, you do not lose money in nominal terms. If you look at your account balance, the number goes up. You feel safe. You feel like you are making progress. But in real terms, you are being bled dry. This is where the concept of negative real yields comes into play. Let's do the arithmetic that the government hopes you never do. Let us assume the new regulations force your pension fund to buy Treasury bonds that pay 4% interest. On your statement, you see a 4% gain. But what is the real rate of inflation? I am not talking about the CPI number that the government manipulates. I am talking about the real cost of living, the cost of food, the cost of energy, the cost of healthcare, the cost of insurance. Real inflation in this environment is likely running closer to 8 or 10%. So let's do the math. You earn 4% interest. Inflation eats 8% of your purchasing power. Your real return is negative 4%. Every single year, your wealth shrinks by 4%. You are not saving for retirement. You are subsidizing the government. This is an invisible tax. They do not have to pass a bill in Congress to raise your income tax. They do not have to have a debate on CNN about raising the capital gains tax. They simply force you to hold an asset that pays you less than the rate of inflation. The difference between the inflation rate and the interest rate is the amount of wealth that is being transferred from you to them. It is perfect, it is legal, and it is devastating over time. If you lose 4% of your purchasing power every year for 10 years, you have lost nearly 40% of your life savings. You retire with the same number of dollars, but those dollars buy half as much food. They buy half as much heating oil. They buy half as much medical care. You wake up 10 years from now and realize that you are poor. But by then, it is too late. The wealth has already been transferred. The debt has been inflated away. This is exactly what the United States did after World War II. They had a massive debt pile from the war. They couldn't pay it back. So they capped interest rates and let inflation run hot. They forced institutions to buy the bonds. And over a period of 30 years, they liquidated the debt by liquidating the purchasing power of the American saver. They are running the same playbook again, but this time the debt is exponentially larger. And this time, the victim is not just the wealthy bondholder. The victim is the teacher with a pension. The victim is the nurse with a 401k. The victim is the factory worker with an IRA. The victim is you. India knows this history. That is why they sold $50 billion worth of bonds. They know that when a government gets into a debt trap, the first casualty is the bondholder. They refuse to be the victim. They took their chips off the table, but you are still sitting at the table, and the dealer is changing the rules to make sure you cannot leave. The legal framework. You need to understand that the legal framework for this is already being built. You will hear politicians talking about automatic IRAs. They will frame it as a way to help people save who don't have a plan at work. But look at the fine print. Look at where that money is directed. It is almost always directed into government-approved funds. It is directed into the sovereign debt market. You will see proposals to tax unrealized capital gains. This is designed to force you to sell other assets and move into cash or bonds to pay the tax. You will see capital controls disguised as anti-money laundering measures. They will make it harder and harder to move your money out of the country. They will make it harder to buy Bitcoin. They will make it harder to buy physical gold without reporting it to a dozen agencies. They are building a fence around your money. They are closing the exits. Just like India and China are closing their exposure to the dollar, the US government is closing your ability to exit the dollar. They need your liquidity. They need your savings to keep the Ponzi scheme going for just a few more years. And they will use every tool in the regulatory toolkit to ensure that you comply. They rely on the fact that most people are passive. Most people just check the box on their HR form and forget about it. Most people trust that the target date fund knows what it is doing. Most people assume that if something is regulated by the government, it must be safe. That passivity is what they are counting on. They are counting on you being the boiling frog. They turn up the heat slowly. First, it is a small mandate. Then, it is a larger mandate. Then, it is inflation ticking up. Then, it is a crisis that requires emergency measures. And before you know it, the water is boiling and your savings are cooked. the exit plan. So where does this leave us? We have established that the smart money is leaving. We have established that the government is desperate for a new buyer. We have established that the mechanism of financial repression creates a negative real yield that destroys your wealth over time. The situation is serious, but it is not hopeless. You are not helpless. The most dangerous thing you can do right now is nothing. The most dangerous thing you can do is to assume that the strategy that worked for the last 40 years will work for the next 10. It won't. The 60/40 portfolio is dead because the 40% that is in bonds is now a guaranteed loss mechanism in real terms. You have to think differently. You have to think like the Reserve Bank of India. You have to focus on the return of your capital, not just the return on your capital. You have to look for assets that cannot be inflated away. You have to look for assets that do not have counterparty risk. You have to look for assets that stand outside of the financial repression cage. India bought gold. China bought infrastructure and commodities. They moved from paper to physics. You need to consider doing the same with your retirement savings. Most people think they are stuck in their 401k. Most people think they can only buy the funds that are on the menu provided by their employer, but that is not true. There are legal structures that allow you to take control of your retirement funds. There are ways to opt out of the captive audience. There are ways to own physical gold, real estate, and other hard assets inside a tax-advantaged account. But the window to do this is closing. As the crisis accelerates, the regulations will tighten. The exit doors will become smaller. The fees to leave will become higher. India saw the writing on the wall and they moved fast. They sold $50 billion in 12 months. They did not wait for the crisis to hit the front page of the newspaper. They acted on the data. You have the same data in front of you right now. You see the deficits? You see the inflation? You see the foreign exodus? The question is, will you act on it? Or will you wait until you are the last one holding the bag? In my next video, I am going to walk you through the specific step-by-step process of setting up a self-directed IRA. I am going to show you the exact legal structure that wealthy investors use to legally opt out of the pension trap. I will explain how you can hold physical gold and silver in your retirement account without triggering a tax event. This is the information that your HR department will never give you. This is the information that the government hopes you never find, but you cannot afford to miss it. Your financial survival depends on taking control of your own capital. The silent confiscation has already begun. Don't let them take what you have worked your entire life to build. Make sure you are subscribed and have notifications turned on. You do not want to miss the next briefing. I'll see you there. The media wants you focused on Venezuela, but the real financial bomb just detonated in Mumbai. India dumped $50 billion in US Treasuries in a single year. China is printing money to buy hard assets, not US debt. The world's biggest creditors are leaving. This creates a terrifying void. Who will buy the trillions in new US debt? The answer is you. In this video, I expose the silent confiscation, the mechanism of financial repression designed to trap your 401k and pension fund into buying the debt that the rest of the world is rejecting. This isn't a conspiracy. It's a regulatory necessity for a bankrupt system. Learn how Prudential Standards are being used to force your savings into negative real-yielding bonds, effectively transferring your wealth to the state without a tax bill. I break down the math of negative real yields, the history of this strategy from the 1940s, and why your retirement account is the captive audience the government needs to survive.